Looking at risk and the risk landscape for Aussie equities and what's the roadmap ahead? Could you tell us what are some of the risks on the horizon for Aussie equity investors?
So I think it's a question of one of the things you raised earlier about buy the rumor, sell the facts. So we've seen very clearly from the US reporting season that we've had very strong numbers coming through from companies, but I think that's yesterday's story. And so when we looking forward, I think one of the things we'll see in the Australian landscape is that there's going to be greater uncertainty with respect to the guidance outlooks that companies will provide. We know that the banks are all going to look very good compared to 12 months ago. I mean, everything has improved from those banks from an operating perspective, and we're seeing an improvement in the dividend profile. We're seeing buybacks. We're seeing improvements in terms of provisioning. Everything has kind of been going their way for the last 12 months. But we also know that much of the state is now in lockdown, and things won't be as good on a forward-looking basis. So I think that will be reflected in less optimistic guidance statements, which we'll see probably reflected in some adjustments to earnings profiles for the next 1 and 2 years. And I think that will probably see some of the steam or some of the heat come out of some of those names that have run quite hard into this reporting season. And that's almost exactly what we saw in the US. So I think that could easily play out in Australia, and that's something that we're certainly thinking about.
What are some of the macro environmental risks that you're seeing in the market right now?
Yeah, so I think we touched on one of the key risks in the market earlier in discussions about US earnings season, about the kind of the buy the rumor, sell the facts concept. But it's also what sits very closely to that is the peak cycle earnings risk. So we've had these very high growth rate numbers, and where to from here. So I think that's definitely a risk. I think the other big risk that we're seeing coming through is around inflation and central bank policy. And we noticed from looking at the statements that came out from companies in the US and other parts of the globe that the mention of inflation was the highest that we've seen in 20 years. So as expected, seeing that we're actually seeing some inflation coming through. And also in terms of supply disruptions, that's another thing that came through, one of the themes. So, but in terms of inflation and the Fed, I think that the market has now for the last few months or so has been focusing more on tapering and when that will happen. These, as payroll numbers continue to print very large numbers, that puts pressure on the Fed to start to change their language with respect to policy. And we're seeing more and more statements talking about policy changes after the end of 2022. So it's certainly that is now in the picture, and that is definitely a risk for equity markets. I mean, I think we'll see some more volatility on the back of that. I think some of the other risks out there is obviously in Australia, we're very close to what's happening with respect to Delta. I think we all felt like this virus was sort of under control, and then we got a new variant. And so there's always a risk there's another variant that could come along that maybe the vaccines won't be so effective against. And so that's certainly a risk. And I think probably the final one that I'm sort of would have in the back of my mind is just around continued trade tensions with respect to the US and China. So they're probably the big ones on my mind at the moment.
Could I ask, with the outlook for inflation, particularly in the
Mm.
US, what you're expecting to see from the central banks in response to that?
Yeah, so central banks, they, part of their mandate is to maintain price stability and inflation targeting. And they've said, in August of 2020, they came out and said, look, they're willing to let that go more than they have previously. And that was a big change in policy. But it's quite interesting because as we get closer and we actually start to see these inflation prints starting to come through, there's obviously the big question of how much is permanent versus transitory, and clearly there are massive base effects in inflation as we see in earnings as well. So I think they are looking through some of that price inflation, but it puts pressure on them to start thinking about how they're going to manage that. And I think as long as the economy continues to be, we're seeing increasing growth coming through and a strong economy that's broadening out, and if we do start to see wage pressures and things like that building, then it does put pressure on the Fed to firstly change their language and then ultimately react in terms of some form of tapering. So that's how I think they have it's within their mandate, so they have no other choice really but to respond to that at some point.
And so, what does all these different risks, what does it do to your fund, and how do you put yourselves in a position to either avoid or just to mitigate some of these upcoming risks?
Yeah, so that goes back to our investment process again. So when we're looking for these companies, we have we're interested in a cohort of stocks which have these high quality characteristics, are reasonably priced, improving operating environment, but that risk also having low risk profiles. So you can think about them as being sort of the more stable businesses, have less. If there's an economic shock, they are less impacted. So they're less cyclical and more stable businesses that can grow despite if economic growth does come off. So that's a core tenet to how we like to invest, and we find that when we invest that way, we get most of our outperformance when markets go through more difficult periods. So when markets are rallying 30% in 12 months, that's not a great environment for us. But if we do see more moderate returns from equity markets and more volatility at more normal levels, then we tend to see some outperformance coming through from that process. So I think we've been through a period where we've had very little stock market other than the massive correction we had with COVID. In the last 12 months, we've had hardly any pullbacks. And that's not normal. So, at some point we will expect to see some kind of correction. One of those risks that I mentioned could be the driver of that. And we're positioned well for that through our very defensive type of investing in stocks that have those elements of quality, value, and sentiment, also lower risk profiles.
And what are some of the indicators you're keeping an eye on for a correction or a pullback? Are there key data points
Yeah.
that you've got on the radar?
Yeah, I mean, I think you want to always be quite open to looking at lots of different things because that's just the nature of financial markets, is that risks can come in from lots of different spots. But some of the key things that I will always look at if I'm trying to gauge what the marketplace is pricing in terms of central banks being aggressive or loose in terms of their policy. I think the yield curve, the 2 minus the 10-year yield curve, is all to give you a sense of what the fixed income market is thinking about Fed policy. So that's always a good one to look at, and we've seen that flattening in recent times, and that's a sign that the outlook there is changing a little bit. So that's a good one to watch. And I think the other one, obviously, that's critical, and we're right in the spotlight at the moment, is with respect to earnings season and guidance from companies and what that's going to look like. So we'll be tracking that very closely over a period over August, of course, to see if those trends emerge the way we expect them to. And so they're probably the big two elements that we'll be tracking closely over the next little while.